The late, great strategist Ray DeVoe said that more money has been lost in the search for yield than at the point of a gun. Utilities may be the latest thing to prove him right. I'm Jack Otter, editor of Barrons.com. I'm here with Ben Levison, senior editor at the magazine. Really interesting Streetwise column from you this weekend on utilities. Very popular right now. First of all, why so popular? Why have they done so well?
I mean, basically, it's their yields. With treasuries so low, you have this sector that's offering 3% plus dividend yield, and that's really attractive. It's about 2 percentage points more than you can get on a treasury. They're also pretty safe, and so when you have a world that looks very scary, the fact that they have very consistent earnings, thanks to the fact that most of them are regulated, makes them a safe sector. You put those two together, you get this incredible rally where they're up more than 20% on the year.
So sounds great. What could go wrong for utilities?
The problem now is that they've moved so much and their valuations have gotten so high that the best case scenario probably at this point is that you clip your coupon. You get your, speaking of bond terms, you get that 3% dividend yield, and that's really the best you can hope for at this point. But there's a very good chance that when you get this kind of run, that if we get more upside in the market, that you're going to underperform. They could even fall if people decide that they want to take their money out of utilities and put it into other sectors.
What sort of valuations are we seeing?
They're just enormous. Whichever way you look at it, in some cases the price to sales ratios are I think the highest since the 1990s. Others are at the highest since the financial crisis, when of course the utilities were popular because they look safe in that environment too. And even if you adjust them for where interest rates are, they still look expensive. I think they have a PE of about 19 now, and even with these interest rates, you can maybe make a case for 18. So it's not that high, but it's still higher than it would be even at these ridiculously low level of interest rates. So if interest rates go up, we could just start a stampede out of these stocks.
Anyone predicting the future would be wise to learn humility. What could be wrong with our thesis? Is there anything we're missing?
I think the thing that we're missing is that do yields stay this low in treasuries?
Bond yield, yeah.
Bond yields stay this low, which could continue to have the support for the yield plays. Will the Fed, stay on hold forever? That could give support. And will the world remain as scary as it has been? Basically, you have to be very pessimistic to think that utilities can go even higher.
Thanks very much, Ben.
Thank you.